Evening and welcome. Good evening and welcome to the ISU Alumni Association Planned Giving Town Hall. My name is Patty Bollinger and I'm president of the ISU Alumni Association. I'm excited about this town hall as we will learn more about how to give cheaper, easier, and smarter. Should you have any questions during the presentation, please use the chat feature. You can submit your questions to the entire group or directly to the host. I'm delighted to introduce our hosts for the evening, Kathy Meza, Executive Director of Development, and Ryan Gerolf, Director of Development for the Kasiska Division of Health Sciences. So Kathy and Ryan, take it away.
Thank you, Patty. Appreciate that. As Patty indicated, my name is Kathy Meza, and I serve as the Executive Director of Development here at Idaho State University. And I joined the team in January of this year, and it's been busy ever since the first day and been building a fabulous team. And I'm very fortunate to be able to work with Ryan Gerolf, who's here tonight with us. And I'm sure that you are going to learn so much from him this evening as well. So we're going to go ahead and get started. Our goals for today, why planned giving? And we're going to take some time to talk with a couple of donors who have already established planned gifts with Idaho State University and talk with them about that experience, about their motivations, and why they considered this as an option for their planning. We will also spend some time talking about opportunities for beneficiary designations, specifically regarding IRA designations and life insurance designations. We are also going to cover 2021 giving incentives, what's new, and what will be ending as of December 31st, which is just around the corner. And then finally, we will be covering charitable gift annuities and guaranteed income streams. We do have some disclaimers. I'll start out by saying that Ryan and I are gift planners, but we are not financial or tax advisors. We hope that the ideas that we are sharing with you this evening will give you some ideas of things that you should be having a discussion with your professional advisor to find the best solution for you. Not everything that we talk about tonight may be appropriate or the best options for you. So we advise you to be sure to take these ideas and questions that you might have that come out of tonight's presentation and have those conversations with your professional advisors. Planned giving gives you options, provides options. This is your opportunity to think big. How do you want your future story to be told? You could lower your taxes as well through planned giving. And there are ways that you can trade a gift for a guaranteed income stream. These are some of the opportunities that we are going to be talking with you about tonight. And we encourage you to think big about how some of these might work in your situation. And now I'm going to turn it over to Ryan.
Perfect. Thank you, Kathy. My mouse is just a little bit sensitive as I go through some of these slides, so apologize for that. But thank you everyone for joining us tonight. As Kathy mentioned, one of those things that I want to focus on with a few of these simple examples of planned giving, really focus on ways where you can make a large charitable gift and really substantially lower your taxes in doing so. And so this first example that you're seeing is if Benny the Bangle is looking to give a donation. Basically, if he's going to do that through a $100,000 cash donation, that's going to provide Benny a nice charitable deduction through that donation. And as you can see up here on the screen, we calculated this out. Again, we kind of oversimplified these calculations just to make them simple to calculate. But we used essentially a standard 24% federal tax rate, kind of middle of the road, as well as Idaho's 6.5% state income tax rate. So if Benny is making a $100,000 donation, then he is potentially eligible for a nice $30,500 charitable deduction through that cash donation. But where we like to mention and talk about plan gifts is is there a better way to make that same donation, to make that same impact that Benny was trying to make, but to simply do it in a slightly different way? So in the second example here, where Benny is giving through stock, we wanted to show you the example. So in this case, instead of giving just a standard cash donation, now this time Benny is making his donation through an appreciated security. And again, this time we're talking about stock in particular. So to calculate these figures, and again, kind of overly simplified, but we used a $100,000 donation of stock, and we were basically finding out that this was stock that Benny had bought at $1. It's now appreciated to $10 through the years. And so essentially, if Benny is making this donation now through stock instead of cash, now he still is eligible for that $30,500 deduction that he was going to get through cash. But by doing it this way, and as long as this stock donation goes directly from the brokerage to the charity, and again, that's an important piece that we don't want anybody to forget, because it does have to go directly from the brokerage to the charity. But if it does that, in that case, Benny also has the potential to avoid another $13,500 in capital gains. So all of a sudden, by simply changing the way that he is making his gift, now Benny is basically has another $13,500 that he can use for his family, his children, or maybe he wants to make an even larger gift now. That allows him to do that. So again, this is just one simple example to show all of you and how planned giving and thinking about the way you're giving can make a large difference for you when it comes to taxes. One other thing too, just to quickly point out before I move to the next slide, is just the fact that as we talk about that capital gains, we calculated that out using just a standard 15% capital gain rate. But depending on your tax bracket, that could actually be even higher, especially with some of the additional fees that are now out there through the Affordable Care Act. So in the second example that I wanted to show you, this one really talks about if somebody is going to be, like yourself, is designating your beneficiaries through your retirement account to your children or to your heirs, then the order that you do so can have a major impact on those heirs and essentially what they're able to receive. And so what you can see here is Benny has decided that he wants to give a $1 million house, which I know in Idaho didn't used to seem like there was that many. I know we have a lot more in the state these days, but he wants to take his $1 million house and his $1 million retirement account. He wants to give one to a charity, he wants to give one to ISU, and he wants to give the other one to his family or to his heirs. So in this example, essentially, if the order in which he makes this is Benny gives the retirement account to his children and his house to the charity, what will happen is that retirement account is going to be taxed at essentially the standard income tax rate, again, calculated out kind of oversimplified, but we use just the 24% and the 6.5% here. And even though Benny isn't necessarily getting estate tax, maybe he doesn't have the estate tax, which is just over 11 million for individuals, and I believe it's just over 22 million for couples at this point. He doesn't qualify for that, but at the same time, the retirement accounts, if they're going to an individual, are still going to be taxed. So again, in this first one, by doing it in that order, his children receive $695,000 and the charity receives a $1 million house. Now I flip that in the second one so you can see what will happen if Benny then just simply switches that order. So he gives the house to his children, which again, it's not part of a state tax, so it's not going to be taxed. And then he again directly lists the charity as ISU, again, as his charitable donor. By doing this, there's going to be no income tax charged to this gift. Now, by doing this simple change, it's a $305,000 difference for Benny and his family. So this is, again, a couple of probably oversimplified, but at the same time, we hope powerful examples that show you just how thinking about the order in which you're making your gifts and the way you're making those gifts can have a large impact for you and your family. And so next, what I would like to do is introduce one of our guests tonight who we feel can do a great job talking a little bit more about why planned giving was important to them. So I'm going to be introducing Arlo Loop, who was a graduate of our College of Pharmacy in 1964. Arlo worked for many years as the CEO as well as co-owner of Varsity Facility Services. He's been active in our community for many years. He's been active with Idaho State for many years. He currently serves as the treasurer of the foundation board for Idaho State, and he has been on our board of directors for the foundation for many years. And so with that, I want to, again, kind of open the conversation up to Arlo so we can talk a little bit more about how he has made a major impact through planned giving. So Arlo, want to double check, are you able to unmute and be part of the conversation?
Am I there?
Yes, I can hear you well. So Arlo, would you like to provide everyone a little bit more background about you and the impact that you made?
Well, I think you mentioned that I graduated from ISU in 1964, and my life was going to be pharmacy or medical. My dad was a dentist, and I remember I always wanted to be a doctor. I was an interested surgeon, and the doctors all in those days, that was back in the 1950s. I don't know if anybody's old enough to remember that, but I am. But they said, "Oh, don't be a doctor. We work day and night and go out house calls and be like your dad, a dentist. He goes home at night." Well, my dad said, "Well, don't be a dentist. Be like Les Crowley in Twin Falls. He has a pharmacy. When he goes home, the pharmacy stays open. He continues having revenue." So anyway, when I took a study at a university other than Idaho State University way back then, when they didn't have maybe the skills they have now to determine where you go, they advised me to do a combination of medical and business. And back then, a pharmacy was a business. They didn't have any chains like Fred Meyer's or Costco or that type of thing. So I went into pharmacy, and when I graduated, I practiced for 3 years full-time and then about 8 years part-time. But when I was going to college, I didn't have a dime, and I just was newly married, and so we went out and worked day and night every weekend and every evening. And I was in a tough course in pharmacy, and I had to make a living. I had to get myself through. So my wife and I both worked. Actually, when I graduated, about 7 years later, I had 4 children, a dog, and a Volkswagen. But my life, when I was going to school, I got involved in a house cleaning outfit with my partner, Don Aslett. And we worked ourselves through school. We started with about 3 or 4 employees and ended up with about 20 college students. And then when we got out, we kept a few little contracts around town, and we were off and running to our professions. But that little business continued to grow, and to the point where I was working day and night and getting out of the pharmacy and traveling over to Jackson Hole, Wyoming, because there's no employees there. And anyway, the long and short of it is I ended up going part-time pharmacy and full-time with my company. And that company started in Pocatello. And when I retired as CEO and became chairman, we had over 6,000 employees in every state and union, and then subcontracted about 2,000 companies. So it was really something I didn't plan for, didn't dream, but it was a wonderful journey. And my roots are still here in Pocatello. I think I've spent 58 years in Pocatello. So in most standards, I'm probably one of the older residents in Pocatello. But I've been very involved in Idaho State University and have had an incredible experience there. I just would share with you a little bit my philosophy of life, because that's what kind of drove me to what I did. I have a personal belief, and we all have different beliefs, but I believe that there's a purpose to life, and that we're not here by accident. And I believe there's a purpose and a plan. I've always had that feeling inside. I've been taught it, but I really believed it. And with that belief, I felt that we all have a stewardship in life. And I felt that stewardship. I felt an obligation to my fellow man. That's not to pat myself on the back or be self-righteous, but that's always a feeling I had. And I think most people feel that way. I think people feel, I think it's a myth that people are bad. I think people are good. They choose to be bad. And so I think that spirit of giving and caring is a natural thing that comes in life. So that's what drove me to serve. And whether we give our time or our talent or our treasure, they're all the same. And when I finished up with my story, I will tell you a few things about that. I wasn't asked to tell these things by those in charge here, but I will share with you my feelings. So you just need to know that the stewardship of giving back has always been part of me. I don't know where I learned it. Maybe I was born with it. Maybe it just came inherent to my soul of all of us. But our company, we started out, and what happened is that for a period of time, we were just Don and I were the owners. We were partners, and as the company kind of grew from Idaho into Utah, and then to Wyoming, and then parts of Arizona, it started to grow, and we were concerned about if something would happen to one of us, our demise, and so we decided we decided that if one of us passed away or had an accident, we didn't want to work for our otherwise family or the members of the family. And so we drew up a buy and sell agreement, and we funded it by life insurance. What I did in 2004 was I gave one of those life insurance policies to Idaho State University in the value of $1 million. And I'll tell you how that happened. So we took out this policy, and our company kept growing, and we kept getting older. And all at once, the cost of those policies went up, and neither one of us died. And we got older, and the company got bigger, and we couldn't keep up with the pace. And then we started to bring in other management to have ownership to motivate them and keep them part of the company. So all at once, the insurance policy, the buy and sell, had no value. We didn't know what to do with it. About that time, Carol Mahar from Idaho State University came to me. She's no longer where she's retired. Her husband, Jim, was a professor at Idaho State University. She came to me, and at the time they were going through a major campaign to raise money for Idaho State University. And it was the biggest campaign that university ever had, and there never has been as big a campaign. But part of that campaign was the building of a performing arts center. It's now called the Stevens Performing Arts Center. Patty on this phone call knows me because I'm deeply in the arts, and I played the symphony all my life and ended up directing the Messiah for 15 to 18 years. And she was a celloist in that. And the arts has always been a deep, deep passion of mine. And I loved it. And at that time, during that big Idaho State University campaign, Carol came to me because she knew of my great passion and love for the arts. She says, we're building this beautiful concert hall, and we just don't have enough money. They had raised quite a bit of money. There's a woman by the name of Thelma Stevens. Her husband was a successful farmer in the area, and she was a widow, and she donated several $1 million, and that's why the Stevens Performing Arts Center is named after her. Another person entered my life. A lot of you know Joe Jensen. He passed away this year, unfortunately, and he's a past chairman of the foundation, and probably one of the most, I think, most influential person we've ever had from Idaho State University and on our foundation board for giving back to Idaho State University. At the time, Carol came to me. I was serving on 3 boards on 3 different universities, including Idaho State University, and I had other thinking of where I wanted to put my money. But she came to me and said, we've got to finish off this Performing Arts Center, and would you consider it? Well, at that time, I was wondering what we should do with our life insurance policies, and I decided to give Idaho State University the $1 million value upon my death. The thing about it is that, as you know, all insurance policies, you don't pay cash for them. You pay ongoing premiums. And there was a certain amount of money in that policy, but not enough to keep it going. I was in my 60s at the time, and I had some health problems. And I really didn't think I'd make it past 70 or 72. I'm 83 right now, so I've robbed everybody. I've got a lot of heart stents, but I'm still going, and got a lot of energy and drive. But that gift to me was probably one of the greatest decisions I've ever made in my life. It became perpetual to me, because I was giving to something that was ongoing, that would touch the lives of the community and would touch thousands of lives of students and people who attended, whether it be a scholarship for education or in a building or just funds to help out the dean. They all touch lives and influence, and it fulfilled a great desire in my heart to give back. And I don't think I'm any different than anybody on this phone call. If they weren't that way, they wouldn't probably be on the phone call. But it's perpetual to me. Every time I go up there and listen to a concert, even at my age, I'm still singing. I'm going to be singing in the Christmas concert, the Messiah, and I'm so excited about it. And I go up there and watch many concerts. So it has really fulfilled a great need to me. To me, education is one of the greatest things one can give to. It's one of the top things, important things in life, including your family, your religion, your health. Education is so essential to the happiness and future of all of us. And when we can bless the lives, especially of students and young people. When I started college, my tuition was $56.35. Well, my minimum wage was about $1.10. Well, the minimum wage today is $7.23, but tuition is somewhere around, I don't know what it is, four to 5,000 now. So the income earning level is way behind the cost of education. And so we students today, young people have a much more challenging time to get through college. So that's kind of my story. When I gave the money, I didn't want it for notoriety. I've gotten a lot of notoriety because of it. They put my name on a big star on the floor in hall, and they got a promenade, and I didn't want that. And I told them I didn't. But Joe Jensen told me, Arlo, by you giving and let people know, there is a certain community part of this community in this region that aren't giving to Idaho State University. And he said, your influence and example would be very powerful. Well, he was right. And so, but I have found out that it's that example not only went to friends and associates, but it went to my own family. They know about my charitable giving. And so it's been a real wonderful thing. I think I'm about done, but let me just make a few other points that I'd like to make to you. I recently heard a podcast about charitable giving, and the people in charge of this program didn't ask me to say this, but I will tell you. This podcast was there's been several studies in the world about gift giving and charitable giving. And it's a proven fact that those who give, and I'm talking about their time, their talent, and their treasure, people who are charitable live longer. People who are charitable are healthier. People who are charitable are happier. When I got on the foundation board and met these people like Beverly Beislein and others and Joe Jensen, I found that these were some of the finest people I've ever met in my life. And I think it's because they're givers. They wanted to give and give back, and it affected their moods and the things that stimulate your body and make you live longer and so forth, endorphins, I think they call them. So I just found out that, and they said that people who give prosper, and they have proven statistics to show that. And I believe it. And so that's my story. I don't know if anybody wants to. The fact is that when I gave it, I had to. The life insurance policy did not have enough money in it to sustain it, and so the universities were stuck with keeping it at $1 million or letting it decrease down. And I chose to, and a few others who had like policies chose to continue to do what was necessary, maybe $10,000 or $20,000 a year to keep it going. But you've already discussed this, Ryan. I don't know, you said some 30%. I think that when you add state and federal tax and in the tax bracket you're in, you're more like 45 to 48%. And the powers that be in this country will probably make it much, much higher. So that's my story. I don't know if anybody has any questions about it, but I can tell you that it's, like I said, one of the greatest decisions I've ever made in my life. And I hope to, in my future, to continue to give back, not only university, but to other organizations.
Perfect. Thanks. Thanks so much for sharing that with all of our guests tonight, Arlo. And then for those questions too, if you're able, if you could just stay with us, we'll take questions at the end of the presentation tonight. So if you're able to stay with us, that would be great. If anybody has any questions, we will take those all at the end. But again, thank you so much. Again, that the planned gift and your dedication and service to ISU. I mean, we have one of the most spectacular, if not, again, one of, if not the most spectacular performing arts centers in the entire country. So thank you for the impact that you have made for Idaho State.
Thank you.
Great. Thank you, Ryan, and thank you, Arlo. So how can you leave your legacy at ISU? We've discussed a couple of these options, but one can be through leaving, naming ISU in your estate plan, in your will. Beneficiary designations. We've talked about insurance designations, and we're going to be touching on IRAs here soon. Appreciated securities. We saw an example earlier in the presentation about how appreciated securities are a great option to give to a charity so that you can avoid paying the tax on the increase in value. Life insurance. Arlo just talked with us about the way that life insurance policies can be a great gift to a charity. Charitable gift annuities, we will talk about those later, as well as charitable trusts. Unfortunately, Jesse is not able to join us this evening due to technical difficulties, so hopefully we can hear from him in a future Planned Giving Town Hall. So at this point, I'm going to turn it over to you, Ryan.
Perfect. Thank you. Thank you, Kathy. And what I am going to be just discussing next is a little bit about what we think is one of the more simple ways to give through planned giving. But at the same time, there is a very specific order and a way to do that that we think can be beneficial for, again, many of you who might be with us on the phone tonight. So the IRA charitable rollover is one of the major ways where people are able to support their favorite charities, just like ISU. Many of you may have even received a postcard about this recently, as we just sent a little reminder to a number of our alumni who were part of this category, who we felt might be interested and know this information. But we have an illustration here that just shows you essentially how a IRA rollover to a charity works. So once you are 70.5 years of age or older, at that point, you can start to use what's called the qualified charitable distribution, or the QCD. And so you can see here the nice picture of basically your IRA maturing over its time, and then finally hatching out again once you hit that 70.5 level. So then once you hit that 70.5 level, then you could, for instance, if you would like, you can take $10,000 distribution from your IRA. And by doing that, you can make a donation directly to like Idaho State University, as you can see here. And by doing that, what will happen is you're not going to show any of the income from that donation you've made through your IRA. So by doing that, you avoid any federal, state, or any other applicable income taxes that might be there, as long as, again, your IRA makes that distribution directly to a qualifying charity. And again, ISU, or Idaho State University's foundation, is one of those qualifying charities. The other thing too, just to mention here, there's no like additional deduction that you actually have. And that's because essentially it's like this income never shows up for you whatsoever. So that's just a simple illustration to say how that works. A few other points too, which I wanted to mention about IRA rollovers, is the fact that, again, these are easy to use, but the funds do have to go directly to that qualified charity. The other piece too, which I wanted to mention, is some of these various terms which are involved with IRAs. So I've already mentioned sort of that QCD, or the qualified charitable contributions. So that's one piece of it. You can start making those qualified charitable distributions once you hit 70 and a half years of age. But they also have something which is often termed the RMD, or the required minimum distributions. So with some of the tax law changes that were just made a few years ago, there's been a few changes basically to these IRA rollovers. As a piece of that, the required minimum distributions age was raised from 70.5 up to 72, which is where it sits right now. Now, the other thing to know is at 72, those RMDs are not going to be only basically be required out of your IRAs, but any other retirement accounts you might have, like a 401k, a 403b, any of those retirement accounts for the most part are always going to have those RMDs, which start once you turn 72. And what that basically means, again, if you haven't got to that point yet, is once you turn 72, the government essentially says you have to start taking distributions from these accounts, whether you want to or not. You really have to start taking them so that they can be potentially taxed for tax purposes. Well, what will happen is, by using your RMD to make a QCD, or that qualifying charitable distribution, again, it's a way where if you don't need that distribution that is coming from your retirement account, or maybe you don't need a portion of that, you don't have to use, it's not like an all or none thing. You can use a portion of it. You can use that that distribution to make a gift to your favorite charities, again, to avoid income tax on that. So again, a great way to think about it is, if you have to take an RMD, you can use it, if you have to make an RMD from your IRA, you can use it and make a QCD to your favorite charities. One other thing too, which we wanted to point out, is just the fact that, reminder too, that QCDs are only going to be available from IRAs. So just be aware of that. If you have other retirement accounts, they don't qualify for a QCD at this point in time through the tax code. But again, just know that one other option you have in working with your financial advisor is that many times you can actually take your other retirement accounts and put them into an IRA if you'd like to start making QCDs. And I know I've just went through a lot of acronyms there, but it's actually fairly simple. We tried to make it easy as well for you. So we actually have an instructions form, which you can see here. We've added this to the isuplandgiving.org website. You can download it and send this off to your IRA custodian. And again, much like Kathy mentioned earlier with our disclaimer, what we really want this to be is just encourage those conversations with your plan administrator to see what's the best way for you to take advantage of some of these savings, again, to your favorite charities. And the final thing that I wanted to point out is just also, just because it's so important, is that your IRA distributions have to go directly to the qualifying charities for you to not have that income show up again on your own personal income. So it has to go directly from your IRA account to the charity. That is a very important step of this process.
Great, thank you, Ryan. I'm going to be talking about giving incentives for 2021. The CARES Act this year provides an above the line deduction of $300 to $600 limit. And then for this year only, if you make a charitable contribution to a qualified charity, you can deduct the equivalent amount from your adjusted gross income, and you can deduct up to 100% of your adjusted gross income. I'm sure that we all have, money burning holes in our pocket. We're able to do that, but it has prompted me to take a look at what we might be able to do, what my husband and I might be able to do before the end of the calendar year to take advantage of this benefit that is in place for this year only. Ryan alerted me to an Idaho education tax credit that I was not aware of since I'm new to Idaho. $500 credit for singles, $1,000 credit for married couples, and $5,000 credit for businesses. So now we are going to be talking about charitable gift annuities. As you can see from the slide, a charitable gift annuity, there's an initial gift in this case, we'll say that the gift annuity is going to be set up through ISU. So we partner with an outside vendor, and I'll give you more information about that in just a moment, to manage these gift annuities for ISU. And so once you write a check or provide funding for a gift annuity, the initial gift is invested in a portion of those funds will be funding the regular payments that will be made to the annuitants. And usually those are paid quarterly, although they can be paid monthly or even annually or twice a year. So there are options there. So as I said, part of the initial payment for those gift annuities is covering it's providing the revenue to cover those monthly or quarterly payments to the annuitants. And then when the annuitants pass, whatever is remaining in that annuity account is then transferred to the charity that the annuitants had designated as the beneficiary of that annuity. So the advantage to the donor is that this annuity also provides a guaranteed income stream. You must be 55 years of age or older to establish a gift annuity, and it requires a $20,000 minimum investment. If we were to drop a proposal for you, you would most likely note that the rates for charitable gift annuities are a bit lower than traditional annuities, but the benefits that are available with a charitable gift annuity is that there's a tax deduction. A portion of the income that is generated is generally tax-free. And when the annuity is discontinued, the residual amounts benefit your favorite charity. One advantage to charitable gift annuities is that you can opt to defer the payments if you are wanting to have an increased payment as you grow older and you anticipate the reduction of other income sources. You can opt to defer payments or portions of payments and then increase your payout as you age and need additional revenue. We have calculators available to help determine the rates, and we can provide a more detailed analysis that provides all of the information I've been covering, what the charitable deduction would be, what the monthly payments would be or quarterly payments. And we would be happy to help you run those numbers and come up with some documents for you. Again, I mentioned earlier that we partner with another organization. It's the National Gift Annuity Foundation. And we are really pleased to be part of this foundation. They have many partnerships across the country with a lot of other nonprofits just like us, and they're very reputable, and they can help us get you set up with a gift annuity in just a few weeks. So this is another great option for people looking for tax deductions and a revenue stream.
All right, thank you, Kathy. Going along in that same essentially thought process of guaranteed income streams that are available through plan giving, we did also want to quickly mention the Charitable Remainder Trust. This is actually similar to the charitable gift annuities in certain ways, in the fact that it does provide a guaranteed income flow stream. But one of the main things to know that's different between a CRT and a gift annuity is that the remainder trust is going to be backed by the assets of the trust and not necessarily the charity as a whole. It's really just going to be those assets which are part of the trust. Another difference between trusts as well as the gift annuities is that these are generally a little bit more complicated to set up and do have to be set up and created by an attorney. So it is one where it's a little bit longer process, generally speaking, but at the same time, there are a number of attorneys who can help set these up for you. And the other thing too to know is that with the CRTs, the gift amounts are generally going to be higher in many cases, just because you are setting up, again, this official trust with an attorney. So for instance, in some cases, ISU or Idaho State University's foundation can actually act as a trustee for some of these particular accounts. But generally speaking, these are, again, a little bit larger. Kathy mentioned the 20,000 for gift annuities. Generally, the CRTs don't start until about 100,000 or more. So there's a few kind of differences between the two. You can also see here, just one thing to note about CRTs, they do have a minimum payout each year, which is just required by the IRS, which is 5% of either the initial value each year if it's done as an annuity trust, or 5% essentially as a fixed percentage of all the trust assets, which can vary year to year through a unit trust. And so that's sort of the kind of the standard payout, which generally happens through the CRTs as well. Again, happy to always provide more information and then also connect anybody, potentially to local attorneys, or at least direct you to potential people who could answer more questions about how you would set up a CRT if anybody does have questions about that. And as we're getting ready to sort of wrap up, a few other options that we wanted to just quickly mention so that you know that these are available, especially obviously with how crazy things have been, at least in Idaho, and I think really across the country with homes and with land values over the last few years. Those can be a great way to support your favorite charities as well. Is those donations of your home or your land? You can obviously do that easily through a will. But if somebody was looking for a earlier, wanted to actually receive a tax deduction for that now, no, there are even some options such as retained life estates that can benefit you now, and very low IRS rates through some of the applicable interest rates can be beneficial at the current level. Arlo already mentioned, again, life insurance being a great tool and a great vehicle to set these up. We talked a little bit about charitable lead trusts, we won't talk about it too much, but just know that is primarily a tool which is used for much larger planned gifts where people are looking to avoid estate tax and, again, help their heirs out at least with that estate tax. And then donor advised funds is another option where if you're looking to sort of bunch your donations to a number of charities in one year, sometimes donor advised funds can be a great tool for that. And those are the main things that we wanted to point out. Just know that there are some other options available to you once you decide kind of what your preference would be and how you would like to make an impact.
Great, thanks, Ryan. Wanted to make sure that you're aware that we do have resources available. If you're interested in additional options, please reach out to us or reach out to your Director of Development. I'm going to have a slide up next with their names so that you can reach out to them. We're happy to provide custom proposals or walk you through calculators for different planned giving vehicles that you're interested in. We have a website, isuplannedgiving.org. A lot of resources there. Please be sure to check it out. And once again, Ryan and I are not financial advisors or financial planners. We are gift planners. We just know that some of these topics that we have been discussing this evening are great, can be great tools for people who are wanting to give to charities that they support and care deeply for, as well as finding ways to care for their family as well. So we hope that these conversations this evening will be conversation starters for you as you meet with your financial advisors, financial planners and attorneys or accountants, whoever you are meeting with. Next slide is the list of development officers on our team and each of the areas that they support. If you want to write down the name of the person in the college that you generally support and contact them, they'd be happy to answer any questions you might have. And again, you can also contact Ryan or myself as well. So we hope after spending some time with us this evening that you now know how to give smarter by taking advantage of tax benefits through your gift planning, specifically through IRAs and CARES Act information we shared. You can start leaving your legacy today without writing a check, and guaranteed income is available to you that still benefits your favorite charities. So thank you very much for joining us this evening. I think that there are some questions that you may have for us.
Amy, do you have the questions that have come in?
I do. There are two questions. The first is, can a stock donation get tax savings over more than 1 year, like 3 years? Question mark.
Hey, Kathy, do you want me to take that one?
Sure.
Okay. So, and I think that's a great question in terms of, can that be spread out over the 3-year time period? I think one of the things we always say in gift planning is it depends. And so I feel like that's partially my starting answer to this, is it does sort of depend. One thing though, which is different, there is obviously kind of in the past that that rollover period is generally there, since you can't deduct your entire adjusted gross income for a 1-year period. However, basically this year, because you can actually deduct 100% of your adjusted gross income, it is a potential way, again, basically to take your adjusted gross income down to 0. Now, if you're already if your stock donation is going to be larger than your adjusted gross income, I don't know, again, on my end, the rules of if you can carry that over beyond that for the stock donation this year. And that would actually be one where, again, I would actually check with your accountant to see what exactly is available. Because I know the carryover is something which happens much more frequently when you only have around the 50 to 60% of your deduction available. But generally this year, I don't know if we'll see that carryover enacted or basically above and beyond that, that adjusted gross income, since it is 100% this year.
So as a follow-up then, Ryan, to that question, is there an upper limit to that 100% number?
So that is a great question, Amy. As I was looking, it really, as long as it's, again, it is based on your adjusted gross income, but as long as it is basically, and again, please always verify and double check with your accountant, double check with your financial advisor, just to make sure there's not an extenuating circumstance for your situation. But as long as it covers, again, your AGI is covered, whatever your AGI is, that's essentially what the max is going to be, Amy. So if it's part of your adjusted gross income, then it's going to be 100%. And there does not appear to be a limit on that beyond that major kind of stipulation.
Great. And there was a comment here that says the Rotary Foundation DAF donations do carry over more than 1 year. So, and then another question is, have we ever looked into single premium life insurance policies? For example, a single premium payment of $10,000 would pay for the lifetime of the policy.
I am not sure if ISU has looked into that. I do know that I think there are so many different types of life insurance policies and so many different ways to approach that I think that ISU Foundation you need to look very carefully at what policies we would be interested in doing. So, but I think that's a good question that we can be researching.
Is that all the questions that we have?
Yes, those are all the questions.
Thank you. Thank you, everyone. Arlo, thanks so much for your story. Just great. Ryan and Kathy, so much information. You're right, so many acronyms and the laws or tax laws are changing. So great advice to consult with a tax specialist with an accountant, but such good ideas. I really appreciate your time and putting together this presentation. Thank you for everyone who participated, and look forward to seeing everyone again. So thanks very much.
Thank you, everyone, for joining us.
Yes, thank you. We enjoyed the questions, and I'm sure that there may be more. So. Now, Amy is